Well, Germany's pulled out its whatever it takes moment. And we've got China NPC meeting coming out largely as expected, but with such a focus on consumption and innovation, Chinese equity bulls look like they're very much in for a good ride here. We've got tariffs very much front and centre. We've hit peak noise, peak chaos. I have no idea how US businesses prepare themselves for what is really being made up on the fly, but certainly traders have to sort of tackle that situation as we go along. And if we look at markets, we've got the US dollar getting absolutely slammed at the moment. It is downright ugly with euro dollar pushing 108. We've got cable 129 and we've got Dolly Yen testing critical support levels at the moment. But there's certainly a lot going on in financial markets. We've got momentum moves coming through in equity markets. I talked about the US dollar. How far can that go before we look to fade that move? There's a lot of noise in this market, and we're going to try and make sense of it today in today's trade-off. Well, hi there. My name's Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be discussing all the factors that are going on in this market, trying to make sense of what's pretty much a crazy, topsy-turvy world at the moment. Anyway, Mr. Blake Morrow, would you come into the programme, my good sir? I pity anyone who reacts to headline risk at the moment. It's full of noise, peak chaos. It feels like a lot's being made up on the fly. You know, 1 minute we got tariffs coming in, next minute it's sort of pulled back. There's things being carved out. I have no idea how a US business, if you've got to make strategic decisions over the long term, plans for anything at the moment. There's just such little visibility playing through. But, you know, you are seeing some big moves playing in markets, which can suit certain people. I wouldn't be looking at the headlines. I don't think many people are trying to do that at the moment, but it's pretty crazy, right?
I'll tell you what, I look at every headline and I pretty much react to every headline I react to every level I see. And it's very, very, very tiring. I was explaining to our producer before we started that, these days are great for traders. I think we had a long conversation last week about having to be very nimble and, taking everything to every time frame down. But although I find it extremely profitable, it is extremely tiring. You know, how do you sit there and go,
how do you actually go and trade off something when, you don't know if the market's going to react to it? I mean, you can say, well, that sounds like it's dollar positive or dollar negative. But if the market doesn't react to it, what do you do in that situation? I mean, did you cut the position?
Quickly. Get out quickly. Like, a lot of these headlines today, like, Lutnick's comments are just coming fast and furious, and as they come, you trade it, and if you don't get the reaction quickly, you get out of it. I mean, I'm very, very quick about cutting losses quick and even taking profits rather quickly. If you looked at my trades intraday, it's just scalping all day long, and it's tiring, and it was much easier to do when I was in my 20s versus in my 50s. But what can you do?
Scalper, fast money man, good lad. Anyway, let's see what's going on with the news. Let's go to Topical Thunder. Fiscal dreaming. Now, obviously we've seen Germany. They pulled out this kind of whatever it takes moment, sort of channeling their inner Mario Draghi. Pulled out half a trillion euro infrastructure spend on top of the defence spend. We're sort of expecting probably a total package now in terms of fiscal, which should make it through the vote next week. How much are you saying?
Isn't it like 800?
I reckon we're going to be close to €1 trillion by the time this is done. And I mean, obviously, this is massive amounts of money, and we're talking about doing what needs to be done, and that's not a comment that you pull out lightly, because that was a defining moment for the euro, for the monetary union. And to come out and start talking about that is, you're basically trying to create a reaction. You are telling people it doesn't matter anymore. We will blow out the deficit, and we're going to have a steeper yield curve, whatever. It doesn't matter. We're going to get the reaction that needs to be done. And I think from especially from a country which has obviously been so fiscally frugal for so long. I mean, this is such a big moment, and we're obviously now watching to see what some of the other countries do, such as Spain, for example. They've got to run a defence budget of defence spending of about 1.3% of GDP, which is far lower than a lot of the other countries. So there's a lot of these other countries that will need to do more. But obviously, that's a big issue. Obviously, we talked about China as well. I don't think we're overly surprised by what we saw yesterday. Their deficit, their sort of total package is going to be about 2 trillion yuan. But their focus on consumption and innovation within that, I think the word consumption was used 27 times, was very positive for there as well. So we are in a world now where, I mean, the euro's absolutely gone for it. European bonds have been smacked. How have you looked at this?
I mean, the breakdown in Bunds and the German Bund is unruly. It's ridiculous. But the thing is, the thing is you got to respect what you're seeing on the charts, and you got to respect what you're seeing in the markets. You've been discussing over the last couple of weeks price action. I mean, price action is paramount at this point. Just notice how the euro rallies and it stops. It's not even pulling back. And we're going to talk a lot about the dollar. We're going to talk about the euro and kind of what we're seeing. And I think you just have to be respectful of what you see, and that's why. I know as a trader, we want to be able to fade these moves or, see, two-way price action. But right now it is one way. It's a one-way train. You're either getting on the train or you get out of the way of the train. That's just kind of the way it is.
On the FX side, right? So we can talk about the dollar in a second. But right now on the euro, I haven't seen this amount of strategists, market analysts in the sell side becoming as bullish they are on the euro in itself, in isolation, than we've seen for years. So this idea about blowing out the fiscal rule, blowing out the deficit, and working more homogeneously as a collective unit, I mean, this is a really big positive. And I think I haven't seen so much love for the euro in a long time. So where are we looking? Are we thinking 110 comes to fruition, 115 over time? We don't like to use levels, but
110 is triangle resistance, but. And I got some targets for you guys here in a little bit, but I'll tell you, it's really interesting because yesterday on Twitter, I saw somebody, and I'm not going to say who, because I just don't do that. Somebody was literally calling parity 36 hours ago and was on CNBC just moments ago that I was watching, completely flip-flop, like going the other direction. Tweets got deleted. Forecast got deleted. It all happens. Yeah, it's crazy. That's how big of a deal it's been.
Everyone's talking upside now, and the options market's incredible now. If you look at skew, 1 week, 1 month skew, which basically looks at the implied volatility of calls relative to puts, we're at extreme levels now. So people are saying if there's going to be a move in euro dollar, it's to the upside. So pullbacks will be shallow, I reckon, and I think this is a pretty defining moment for the eurozone.
I just want to add one more thing. Ryan Littlestone, who Michael Brown's colleague on the UK trade-off, which you guys should be watching, he was just looking at the option skews and how there's very little pricing between 108 and 110. And so all these traders have to re-engage into their option barriers. So they're even for the next 24 to 48 hours, there might not be a lot of resistance, if you will.
Yeah, we've got the ECB meeting tonight, so don't expect any, given the lack of clarity from Fiscal, tariffs, one suspects their guidance is going to be very vague.
Yeah, well, speaking of which, because it all centers around, unfortunately, it's the dollar. Let's switch topics. Let's talk a little bit about the dollar, because having conversations about what's happening in Europe and the Eurozone. And you've seen sterling actually have a really big response, but the dollar, it's not one size fits all. I mean, you look at the Aussie, and the Aussie is still struggling. I mean, I am long some Aussie dollars against other things, other currencies right now. Hoping we might get a little bit of a catch up trade, but I don't know if that's really more of just a hope. Versus because you're not seeing any technical breaks, at least not yet. We had some data out of the Aussie that's come out, but the Kiwis, struggling. The Canadian, obviously, without clarity, you're seeing the Canadian at the weekly lows right now. But I know Trudeau and Trump are like really best friends right now. So being sarcastic. So that's up in the air. But, a lot of European currencies, you're talking about Norwegian krona has absolutely gone berserko the last, despite the breakdown in crude that, you're going to be talking about a little bit later. So you make sure you guys stick around for that. But sterling's ripped, euro's ripped, Swedish krona. Yeah. But then again, you got the Swiss franc that is just getting demolished. So, Chris, it's pretty. It's not everything in the dollar. It's certain pockets. So how are you reading the dollar at this moment in time overall?
Yeah, I think the fiscal response is making the euro very much there, and the UK is getting some tailwinds from that because it looks like the UK and Europe are working closely together on the Ukraine side, and obviously the pound's a bit of a risk currency as well. So I think there's, you are getting some tailwinds from that, but obviously, Dolly Yen at the moment is holding that really big support level around sort of 148.80 is huge support level. So that's maybe curbing up some of the situation there as well. But I think with the dollar at the moment, it's interesting because I think Trump would have loved what he saw last night. Equities higher, dollar down, crude down. The only thing he had missing was that he would have liked to have seen yields down a little bit on the 10-year. Yes, but the fact that the yields were pretty much unchanged or up a few basis points, despite what we saw in the UK and German bond markets, he'd be pretty happy with that. So I think it was a night for Trump, effectively, in terms of the financial markets and his needs and wants. But look, there's options now. People are saying there's actual attractions for the euro. There's actual attractions for other currencies, and people are moving their money out of the dollar. And we did see some better data last night in the services, but what we didn't like was the prices paid component of that. The ISM director came out and said that companies are seeing these higher prices, but they're failing to be able to pass it on because of lack of demand. That message was true in the beige book as well. We saw that a number of districts are saying that they're seeing higher prices, and again, they can't pass this on because of lower demand. So that's going to hit corporate margins. Now, it feeds nicely into payrolls in a second, but when the US economy is slowing down, and there's obviously this big point of conjecture that there's a bit of a Trump put out there, and the idea that Scott Bessent and Trump are actually trying to slow the economy to bring down the dollar and bring down longer term yields. Obviously, it's a very dangerous game to play. And now they're seeing attractions in China, European growth. And I think that's really where we're seeing that US exceptionalism story coming under pressure. And I think China, on the innovation side as well, they've put so much pressure, they've put so much emphasis on the idea that we're going to see better, this huge tech transformation in China. And again, it just makes you say that, this concentrated pool of capital, which is still in US equities, that may be heading out to the east. I think that, again, just questions that exceptionalism story, which is very much in play at the moment. So the dollar's down. I like selling rallies in it. Anyway, that's where we go. Let's go to the equity market.
And you pointed out, Chris, before we move on, that it's going to make a really, really good segment here when we talk about the jobs report in just a couple.
Sure. Yeah, look, let's feed into that in a second. But the US equity market, look, we've seen these ripping moves coming through in European equity. Certainly the DAX was up over 3%. That market is just on an absolute tear at the moment. It's the best performing market of any on a risk adjusted basis this year. You can have a look at Chinese equity markets. Hong Kong equity market's going to make a new run high today. There's some big moves being taken out in equity markets, but it's certainly US equity markets, which was down, underperforming, and it's something that we're not used to. We're just not used to seeing the US equity market underperform on a year-to-date basis. But that's where we are. And I think, what you've seen for most this year is tech's been in the doghouse. People have been rotating into very low volatility stocks, those really defensive plays with very predictable cash flows, very good balance sheets. It's been a quality defensive move that people have migrated to. And what we've seen, obviously, NVIDIA is a big part of that. We've got GTC coming up next week, and we'll see if we give a melt up into that, because that's typically a positive situation. But, obviously with tech at the moment, no one really wants to buy that because we've got this export control overhangs hanging over them, and people want to get that out of the way before they start buying NVIDIA. But we've had a one-day move, right? So people covered a lot of shorts in some of the Mag 7 stocks. Can we trust it? We had a nice rally off the 200-day moving average in both NASDAQ and S&P futures. That's your line in the sand in the equity markets, in the indices. But we've had one day, solid gains. Do we buy? Or is this a fickle market that could easily roll over again?
Well, the 5850 level is a breakdown of a long-term channel that we've been following for a while. And we had a rejection of it yesterday. So right at the end of the day in the North American session, literally about an hour before the market closed, just a big sell-off. Everybody's looking around for headlines. No headlines. That was just the underside of that channel, just rejection. Today, same thing. Now, we didn't get a huge sell-off, but we're still consolidating below there. You're right. The 200 DMA is big support, not only for the SPOOs or the S&P, but also for Bitcoin. And you notice how Bitcoin's holding that 200 DMA as well. I don't know if we can really trust it, Chris. I gotta tell you or tell everybody that if you watched our end of year special, we talked about how the U.S. exceptionalism story or money is going to be going into different markets, whether it was the Nikkei or the DAX or other markets. And I think that that's really taking place now. And so it's something that we obviously can visually see. And I think that's going to be characteristic of most of this of 2025 is, the European markets, the DAX is going to get tired at some point. I don't know if today's the day, but when it does, and when some of these other markets, whether you're talking about the FTSE that's at the 161% extension or whatever, when those markets get a little tired, I think you're going to start to see selling really come in the U.S. equity markets because they are, as you pointed out, underperforming now. So, yeah. So, anyway, I'm going to talk about our last topic so we can get on to our setups, but it's really going to be about the non-farm payroll, about the jobs data. It's we've seen, as you pointed out, some mixed data. ISM, as you pointed out, the services came in a little bit better than expected, but the ADP data, the ADP data, I thought would be. I didn't think it was going to come out as bad as it did, but that's a little alarming, because that's the private sector data, right? So now we're going to get the BLS data coming up, but we still have weekly unemployment claims and some other things that we're going to be looking at as far as jobs go. But Chris, this jobs data, we're pretty accustomed to trading. First of all, we're accustomed to trading strong data, so that's in question now. And if the data is strong, what do you do? I mean, I'm used to just shorting the euro. The euro has been a great, place to just be long dollars, short Europe. Europe sucks. US is great. That story is flipping, obviously. So, now my playbook, I think, is going to be changing. I'd love to hear yours, and I'm sure every trader here would love to hear yours as well. But, weak US data, weak US news. And remember, it's a Canadian jobs report too, especially if we get weak data, strong Canadian jobs. I'm actually shorting the dollar CAD. I still want to play the dollar yen to the downside. I think the dollar yen is hovering below 150, big pivot at 152, but more importantly, it can't even get above 151 for more than, an hour. So as long as it trades below 151, I think we still focus to that on the downside. But if it's a weak data, I mean, you threw out some numbers in the Europe, in euro, 110, 109. I think those are all really possible targets, maybe as early, maybe even before jobs. So how are you going to play non-farm payroll this week? Is it going to be a little different than normal?
Well, you just got to go back to the old idea of the market's reaction function. And look, the payrolls number is difficult relative to a lot of the other data points because there's obviously multiple things. You've got to look at the jobs creation, the unemployment rates, the average hourly earnings, the revisions. There's the market will pick and choose what it wants to see. You're never going to get all four of them aligned perfectly. You can get conflict coming through. So it's always difficult to see and make a playbook on payrolls relative to things which are just, one index, like, the CPI number, for example. Sure. But that said, I think we're in its totality, where is the reaction function of the market? And I think the market is clearly more concerned about, obviously growth is the big concern at the moment. So I think any kind of weakness is going to see a bigger move in the dollar relative to a strong payrolls number that could cause an upside reaction. So, I think the market reaction function is they're going to be far more sensitive to any kind of miss. So a slightly higher unemployment number than expected. Let's say the market's looking for 4%. If you got 4.2%, then obviously I think the dollar gets smacked. Dolly Yen goes down hard. Euro dollar pulls 109. Over time. So that's the biggest issue for me. Is you look at the consensus numbers, 160 on the payrolls, 4% average hourly earnings. You're looking at, I would say, and correct me if you think any differently, but I'd say given that growth is the big concern. And whilst the dollar's already had a reasonable fall, I think the move that you get on the dollar to a broad miss and a bad feel to the payrolls number, will be more prolific to the downside than a relief rally on a good number.
I do agree with that. And actually, even on strong data, people will say that's strong, but the next month is not going to be as strong. So whatever selling that we see in dollars, buying in dollars on a good number, I'd be more akin to actually selling it after the reaction.
Also, I think we're looking at payrolls, but next week we've got CPI. I also really want to have a look at the retail sales number and also the NFIB Small Business Optimism Survey. I think that's going to be a really big one now because obviously, Trump talked about it in his State of the Union in his speech yesterday. But he talked about the idea there'd been this massive jump up. Now, obviously, as I talked about in the synopsis, this idea that businesses just can't plan for the future under a world where tariffs are changing so radically every day. Now, will we see that small business optimism take a dive, and by how much? I think the market's going to be quite sensitive to that, as they are the consumption patterns in retail sales. So I think market's going to be pretty sensitive to those next week as well.
You look at all these sentiment indicators and they're looking a little shaky. So I agree. I agree with that, Chris.
All right, cool. Let's go to the charts that matter. Right, Blake, let's go to euro dollar because obviously everyone's talking about this at the moment. Now, I haven't actually got a chart of euro dollar per se, but I wanted to show you the move in rates. I mean, we could have used the relative spread between the German 10-year and what we've seen in US Treasuries, because that's exploded, and we've seen that the differential, the discount that the German 10-year wears to US Treasuries come in. But what I've actually shown you here is what we call the one-year rate. So these are basically the forward assumptions of expectations of the ECB pricing relative to US pricing, the market's interpretation of the longer-term Fed pricing. Now, I'm not going to talk about the absolute levels, but you can see that they've absolutely ballooned up. So the white line really is what's priced into Europe relative to US, and you can see that there's been a very, very strong correlation between this. So this isn't, fiscal's been the driver, but obviously what we've seen is the interpretation of where the ECB is going to be with rates has come in massively against the US dollar. So you can see a very strong relationship for this. So the question for me is will we see these rate settings continue to drive euro dollar? This has been at the backbone of the euro dollar rally, and it has been a massive repricing. You can see that we've gone from around 220 basis points of differentials of the market expecting the ECB to cut by more than 220 basis points more than the Fed to about 147 basis points now. So for anyone who wants to fundamentally understand what's driving euro dollar at the moment, it is relative rate settings, it's relative bond settings, and you can see obviously the very strong move that we've been seeing in ECB pricing. And it comes back to the ECB meeting in the session ahead. What will they say about terminal pricing? What will they say about the visibility under tariffs, geopolitical issues, and also what we're seeing on the fiscal side? But you can see, for anyone who wants to actually sort of fundamentally understand what's at the backbone of driving euro dollar higher, it's this relative rate settings.
Chris, that's a spicy meatball you got there, man. All right. Well, I'm going to stick with the euro theme, and that was a really horrible Chinese guy trying to make an Italian.
I was going to say, you should have done a German accent. They were the ones responsible for it.
All right. So, hey, the blow up here is the Euro Swiss. And, I'm a little irritated with myself because I actually been looking at this chart for so long, waiting for this double bottom, range breakout, and it blew out to the upside today. And I completely 100% missed it. But that doesn't mean that it's over. And I think we've got a long way to go on the Euro Swiss. And I am buying dips. I hope the ECB tomorrow gives us a little bit of an opportunity for some Euro softness. I'm going to look for any dip back down to like 95.50. And I think we continue higher. I think that's a very impulsive breakout. So the range extension takes us eventually above 98 cents. And, remember the Euro Swiss is just near historic lows. So we've got a lot of potential upside here. If there's some momentum, I believe there's momentum right now. That's why I'm looking for dips to buy it. And I think it's a setup worth noting for this week.
Good man. Chris. All right, cool. Let's take it over to the commodity markets. Let's go to crude because that's obviously front of mind to a lot of people at the moment. We are right at those lows, as you can see. We did come down and test the September lows. There's a longer-term trend line in place as well, which I haven't drawn, but if you can go back a little bit further over time and see that one coming through. fundamentals have caused this to rip lower from $81 to where we are at the moment. It's in a big downtrend. People are selling rallies. Is it exhausted? Do we buy at these levels? That's obviously what a lot of people are going to be doing. That's a setup that we've got in mind. Trump's loving this right now. He's obviously been leaning on the OPEC nations. They're going to be looking to cut back on the output agreement that's been put in place. They're going to increase barrels by about 140,000 from April. That was a big surprise to the market this week. So it does feel like the OPEC plus nations have been a bit politicized by Trump. He's going to be liking the moves we've been seeing. He's obviously campaigned a lot on bringing energy prices down. He's going to be pumping more out the ground. He talked about that yesterday. You've seen higher inventory numbers coming through, and obviously people's perceptions of growth. I know China's on the mend at the moment, but certainly people's perception of US growth is that risks are skewed to the downside at the moment. So does this break? It's the question on everyone's lips. If it does, they could have big implications for risk, for inflation expectations, one we're going to be watching very closely. But this is a setup. We're at massive levels on the crude price here.
Big, huge, bigly. I like it, Chris. All right, and I'm gonna turn your attention over to the stock market. I'm gonna talk about Amazon. And Amazon, we actually formed a really nice low. You can see the low end price was not matched with the low in RSI, so that should allow for a little bit of a bounce. And it's a jungle out there because we're trading. Guys, we're traders. And so what I'm looking for is I'm looking for a move back up in Amazon. And I want to be selling rallies up into that 215 level. I think that previous support is going to be a big resistance on the way back up. Now, listen, when you're talking about Amazon's a good, indicator, not for just U.S. consumption, but global consumption. Amazon's got its tentacles in pretty much every major market around the world. And so with that being said, we've see the higher prices. It's really going to start to bite the consumer, in my opinion. It's going to weigh on consumer spending in the months and probably years ahead. Years might be stretching it, but at least in the months ahead. And I think Amazon price is really showing you a story right now that consumers are really going to be biting the stagflation, genie coming out of the bottle. Higher inflation, lower growth. Probably lower labor markets are a little weaker, and I think Amazon's going to suffer as a result. So I am selling rallies, and I think that's a good setup on any move back up to 215 as a potential short there.
215, got it. All right, thanks, Blake. Lovely little setup there. Interesting to see how NVIDIA trades going into GTC. I know it's obviously a different beast, but I think that's obviously part of the Mag 7 complex, and that's something I'm going to be watching out very, very closely indeed. So it's obviously a very big influential stock on the NASDAQ. Anyway, let's go to play of the day. Let's see what's on front of mind. Yeah, I was looking at CAD Yen last week, actually, and it hasn't really done it certainly hasn't done what I hoped it. It's pretty flat on the week, hasn't done what I was hoping for. Still holding that one at the moment, but I'm looking very much at the HK50, the Hang Seng, because, it's ripping, isn't it? And I think one of the big things, as I talked about there, is China talked about this idea of 5% growth, fully expected, 2% CPI, not unheard of. They're targeting a deficit of 4% of GDP, which again, very much all in line with expectations. But it was the semantics from the words that I think really has driven this market now. It didn't really need an excuse. We had a really lovely rally between January and February. We've had the consolidation. We're just breaking out to the upside. I think this goes higher now. And I think, there's further capital from an international perspective that's going to be chasing this. So these AI names are going to rip again. There's this focus on innovation, this idea that they want to make China a central hub to rival what we're seeing in the US. There's been an explosion in small companies producing inference and using ASIC chips to try and sort of work with DeepSeek. And I think that's going to play through into what we're seeing as China being a new innovation center. But also on the consumption side, I think we're going to see retail names working well, property stocks working well. We're seeing green shoots there as well. I think this goes higher. I know we're all talking about the DAX and this idea about amazing risk-adjusted returns. But I think it's the Hong Kong's the Hang Seng's time to shine again. Chinese mainland equities also working well. We need some more clarity and the meat on the bone that's still going to come from the NPC colour. But I think what we heard there has hit the right tones, and I think this continues to trade higher. So I'm long.
Ooh, man, get on the trainer, get out of the way, Chris.
That's right.
That's all. All right. Hey, I'm going to bring up for my play of the day, it's going to be the dollar index. Now, look, I just want to point out, I am a trader. Had a big discussion with you guys last week. I am very much an intraday trader. And for me, I look for levels that I can play counter trend. I play with the trend, like I'm trying to buy euros on dips over the next couple of days. I think the euro trades up to about 109, 109.20. And that would coincide with the dollar index. And if you look at this 4-hour chart, I'm looking for very extreme oversold conditions. We can get down, in my opinion, if the dollar index continues to play ball here and we feel this gap. It should take us down to about 103.50, 103.60. Somewhere in that neighborhood, we'll feel that gap from a weekend gap higher in the dollar index. You can see the green line right there. It's going to be an overshoot of the 618. And that's the level that I think that the RSI, intraday RSIs, would get extremely oversold. Now, I know a lot of people, I was telling people in our community today, it's like, I don't know where the euro is going to turn, whether it's 108, 108 and a quarter, 109. I think it's more like 109 and some change. Even though some big fib levels around the 108.20 level, the big 618, I still think we can overshoot. When you get these big impulsive moves like this, overshooting is very common. So I'll play it both directions. Ultimately, as most of you know, I was telling you last week, the euro's building a big base, and I think euro's going higher. That was last week, and it is higher. I still think the euro goes higher over time. I think the dollar goes down over time, but I am playing both directions, Chris, and I'm looking for levels that get really extreme. I think that's where it's going to be this week.
Yeah, good stuff. I quite like euro sterling higher as well, from a sort of a fiscal impulse kind of divergence play. You know, they've both had a similar sort of move. Euro sterling is beating or working or outperforming the pound. But I think, we talk relative fiscal. There's probably still some upside in euro sterling if you want to play that sort of lower beta play. Anyway, interesting. Thank you, Blake, for your thoughts and your views there. And everyone at home, thanks for watching. We really appreciate it. Hit the like button, hit the subscribe button. Let us know how you're trading the markets, and we'll see you back next week for more of the same.